Hello, hello, hello. So let's just get everyone into the room here quickly. I'll get my screen up. As you can see, we've got our guests all the way from America. So it's actually early, well, not early morning. What's the time there, guys, in America?
10 a.m. We're capitalists. We've been up for 6 hours.
Love it, love it, love it. So why are we here today? Well, it's all about the launch of the DWG commercial. Why is my screen, Alex, you buggered with my computer again. The DWG commercial industrial deal. We're going to go into all the numbers and everything else today in terms of why it's important. I do remind people that one of the things that we believe very strongly in is diversifying across countries, currencies, assets, partners, and time. However, at the center of it, you'll notice it's all about passive income. What we're going to share with you tonight is not only an 8% plus cash on cash per annum, but also one of the things I love about DWG is they pay monthly. So, very much about the passive income perspective. And again, back to diversity, some of you invested in Manhattan. That deal is actually closing out now. And what I'm super excited is that using technology, we all get access to be able to get involved in smart investing and to be able to live a life unlimited. A quick disclaimer, no, we're not providing financial advice tonight. What we are going to do is share our inputs, our knowledge, and our opinions around this particular deal, but ultimately it's your decision whether you want to take an investment or not. So let's get right into it with regards to the team. They are the partners on the ground, they are the experts. I always say that there's two things when it comes to investing, and most importantly, in terms of reducing risk, and that's getting the right information, number one, and the right partners. And that's why I'm so excited and relieved, actually, that Judd and Ryan and their team are here with us, because this will actually be our third investment that we're doing with them. And not only can we learn about who they are as a team, but we can also get the right information with regards to the deal. And again, I'm not going to go into this in detail, but with our kind of whole due diligence system, remember that we look at the top level macro, what's happening around the world, which countries should you be investing in, which currencies should you be investing in, which cities should you be investing in, then ultimately down to the partner and the caliber and quality of the partner like DWG, and then only getting into the actual property, structuring it, doing the due diligence on the property, maximizing your investment, et cetera, et cetera, et cetera. So I don't have time tonight, and that's not the intention. If you want to go through WealthE Global, which is our digital course, we'll teach you about this, the top 5 countries to invest in, the top 5 currencies. However, what we taught people in that course right now is America is the only place, along with India, that sits in the high return, low risk category, the top yellow, which is where you want to be from a country perspective. However, without further ado, it's time for me to shut up and to stop sharing my screen, because I wanted to do the macro analysis as to why we're in America. The US dollar is clearly a currency that you want to be in, but now it's time to move over to the DWG team to understand the right information about this deal, and most importantly, the caliber of the partner that can help us execute. Judd, it's wonderful to have you here. Ryan, thank you for setting up. And as always, I look forward to our third deal with you. I personally have invested in both of your first two, and I'm really excited to get involved in this third one.
I really appreciate that, everyone, and thank you for having us again. It's an honor and pleasure. Why do we invest? We invest because the success of passive cash flow and building equity gives us more time for God, money, God, family, and nature. And so it's about freedom. So we take your investment really personally. We appreciate you having us partners. I don't know everyone out there, but through Scott, you're always, and Alex, you're always welcome to reach out. And it is a personal, private platform. And we're only, 370 people large, but and you as one of those collective people. And it's an honor and a pleasure to have you here. So, and what are we doing? I've been in the American industry across the United States. I've done billions of dollars in about 38 states, and we've won awards, et cetera. And at this juncture, I'm 57. At this juncture, our platform now at 50 million AUM allows us to use all those years of industry relationships, all our familiarity with the nation, working in every asset class in capital markets and investment sales to do this platform, which is sale leasebacks in industrial. And so thank you for coming, and thank you for considering the investment through Global Wealth. And I'm going to quickly also say hello to John. John is our analyst, and he is extremely talented and had worked at STORE And we occasionally get to have him over from MAG as a benefit of doing a lot of business for MAG. And he works for one of the biggest companies. He's worked for one of the biggest companies in the United States institutionally that does sale-leasebacks. So quick, I'm going to jump over. You get a little preview of my upcoming project that we're doing. And let's see, did you see the screen where my mouse is here?
Yeah, we can see it. Just put it into PowerPoint mode if you don't mind.
PowerPoint mode. Where would I do that at?
Go to view. Go to view.
View. Okay, there we go.
And then go to slideshow.
Mode. There we go. Slide. This one? Is that right?
No, where's slideshow now? Do it. So, Judd, I do it down the bottom right corner normally.
Oh.
Oh, where's it gone now?
Okay, we'll start over. I think I lost that. But that didn't go well. All right, Ryan, I'll have you put that one. Give me 1 second, guys. I wanted to show you this one thing we just did in the United States markets. So we'll go back to normal. I can't get to that, but I'm just going to continue if I may.
Just do it like that. That's fine.
Yeah, I'll drag it over. You asked the wrong Gen X or the wrong millennial question. Okay.
By the way, Joe, do you see where your logo is? It says DWG Capital down in the bottom right side.
Yeah.
If you go straight down from there, there's a little button straight down. No, down.
Okay, got it.
Down. There. No, to the right of that one. Just to the right. One more.
There we are.
Yeah.
That would be it. Okay, great. So quick look. Like, why America? Well, America has exceptional resilience. We have a massive economy related to the world. You have to look at the size of our GDP. Have there been headwinds? Yes. But how have we done on sustaining through them? Exceptional, right? So, and our real estate is good, our economy and our drivers. I'm sure Scott deals with a lot of that. But what's going on in our country right now is very significant. Low industrial cap rates, where if you look at the cycle over time, you see where the cap rates have gone. In only 18 months ago, we were competing for like sub 7 cap deals with heightened competition right before our Fed dealt with the post-pandemic inflationary pressures and all their spending of so much money on a congressional level. So they're chasing down inflation. And when they did that, our Federal Reserve, as you know, because the world reacts to it, had 11 hikes. And those 11 hikes created a dip in cap rates right before that they dipped. They decompressed. So we've been able to do 825, 875, 9 cap, 879 deals, but it's only for a short window because rates are going back down. So we had 5.5 cap rates happening in America. But why is that significant? Because multifamily is mature in 3 cycles. Office was damaged by the pandemic. Retail has online vulnerability, but we've been able to get, in growth logistic markets, we've been able to get aberrant cap rates. And now our debt is closer. But if you look at what's going to happen in the Fed later, you've got, the prediction is that we'll have 100. And here, if you can see, this is the American Fed. So you're going to see within 2 years, it goes down about 200 basis points, meaning your debt rate, the cost of your debt goes down. So right now we're buying at cap rates that are higher than they've historically been and are for a short amount of time. And in the sale-leaseback space, in the less mature industrial space, which can definitely compress a few more times, multifamily has really got the top of its cost, top of its demand, has some vulnerability. Industrial is the darling in America, and we've still got this. We've got this great window, and we're going to do about 10 deals this year. This is one of our first few deals in this cycle, but we've done 4 since this happened. And so you can see here, the Fed did 11 hikes, and then it quickly comes down. So we're using a little higher debt this time, a little bit of carried interest, but we're going to capture this deal that has $500 million in sales. And here's a quick analysis for you. I think this helps you, Scott. So, your clients know that every country you work in, and we're dialed in. Here are the Fed board members' predictions of where they're going to lower the rates. And you can see here like 5.5, and then you get down here and then 4, 1 year, 2 years, 3 years. And we've traditionally already seen this proven after the Fed rate cuts at the Gulf War and the dot-com bust. As fast as they went up, they also went down. So what happens if all that empty office and all those maturities and debt come due next year? The Fed would then retract as quickly as it went up, and it's a political year in America. So it's a great time to buy here. You can see some of our stats on when we've gone up and when we've got down. And here are a few quotes on that. Successful investing is about managing risk, not avoiding it. You make most of your money in a bear market. You just don't realize it at the time. And the great one, I will tell you how to become rich. Close the doors. Be fearful when others are greedy. Be greedy when others are fearful. By Warren Buffett. I don't like the word greedy, but that's a great analysis for that. So I'll stop sharing with that. That's what's going on in the world of DWG. Like, we're really looking at the macro. We're planning on expanding the portfolio. And so this deal that we're going to talk about today.
Quickly, Judd, just two things very quickly. So I just want to kind of, Judd and I always have a bit of fun when we do these, because I end up being the English.
You interpret now.
I just want to kind of just explain a little bit about what Judd just said there. So just in simple terms, what he said. So if you don't understand cap rates and everything in between, then I suggest that you do one of our courses. I'm not going to give a course tonight in cap rates. But what Judd basically was trying to say is that if you've got an environment where cap rates are coming down, that means that properties are becoming more expensive. So, and because interest rates have gone up, it basically means that cap rates have gone up, which basically means you're buying properties at a discount. And when when the interest rates come back down, then the cap rates are expected to come back down, which means you get more capital growth. Does that make sense, basically? So, and Judd, just shout if I'm getting anything wrong in your eyes in what I said. So basically what Judd's saying, to take Warren Buffett's perspective, is there's been fear in the market, interest rates have risen, it's created volatility, and because of that, it's created a great buying opportunity. And literally one of the most important things when it comes to buying real estate, whether it's houses or commercial buildings, is buy from motivated sellers. And what does this environment create? Motivated sellers. Back to you, Judd.
Yeah, exactly. And the key element with that too is that M&A growth, merger and acquisition growth in businesses, industrial businesses that own their real estate and they own their businesses, they're not related to just the real estate market. They need to grow. Their product is doing well. They need to borrow. They'll sell their real estate so they can make more products. They'll make more money in the business side. So in the short term, sale-leaseback capital at these high rates for sale-leasebacks is a very high demand. And we're in a neat window where after one decompression and one compression of cap rates, when they got lower and more valuable, decompressed, we'll buy them here, they'll recompress and create some value. And all the indicators are that those of us that are contrarian and professional, it's a great time to buy industrial in the nation. There's a couple elements. So that's a whole different element. But I wanted to give you that perspective.
There's also one stat that you shared with our mastermind, which I love, which according to the research, if you keep investing through all the cycles, by the time you're 65, you'll be 30% better off than if you try and time the market. And it's a stat you gave me, and I love it because, it just shows people that if you find good partners, get the right information, and consistently invest, you'll be better off than if you try and time the market, because no one has a crystal ball.
Yeah, absolutely. Absolutely. Did I get the right slide? There we go. Right? Okay, good. Okay, great, folks. So I'm a stat nerd. I'm a long-term broker. I'm a finance guy. I love real estate. I love working with you guys. And I love this sector. And it's great to have John here and Ryan here, and all the team. That's what we do day and night. So let's talk about the deal. So this is the strongest credit deal that we've had. Like, we did Lancaster last year, like $400 million in sales, 7 locations. This is a $500 million company that I'll have Ryan go into, and I'll have John go into a little bit more about the financials, and I'll let them get into the specifics on that. But we're buying it at an 8.25 cap. We might get an 8.5 cap. That's why we're pushing for funds due a little earlier. We'll make that happen. And then we might get a discount. It depends on the timing of the underlying sale. So this company, JALandmarketing.com, they're buying Mossberg for strategic reasons. This location, 65,000 square feet. They're tying it into a bigger company. So our lease is going to be with marketing.com, and our collective guarantee is going to be $500 million in sales. We hope that company will become several billion, maybe even go public one day. If so, our cap rate would even get exceptional. That's called a credit enhancement opportunity. We don't know if that'll happen, but we've got great, strong credit. The markets are crazy. $500 million isn't going anywhere for a small lease like this. So we're pretty happy about that. It's about a $5 million bite. It's a 65,000 square foot deal. I like this space. It's not really competed a lot by the REITs. So we have a lot of leg room in here, and there's a lot of activity in it. That's DWG's specialties, this like 3 to 9 space. And we have to do a lot of underwriting to make sure the tenants are tight. This is a great tenant. 65,000 square feet with 4.37 acres with an older building, but it's been remodeled again and again and again. It's got a very long seasoned business in it, and it's in South Bend, Indiana. South Bend, Indiana is interesting because America went through this weird change in the post-pandemic, where logistics centers made areas that were never hotter because they were well positioned for delivering essential industrial goods straight to people's homes. So, for example, Columbus, Ohio is one of the hottest markets in the United States. You would have never thought that 3 years ago. I can give you a series of examples. South Bend, Indiana has one of the top 10 residential growth markets in the United States of America. So this is a more infill deal in South Bend, Indiana. Indiana's Midwest, really stable growth, just really stable economy, nothing crazy dynamic like the beauty of Manhattan, where it sounds like you're investing, or in Phoenix we just did. It's just good, what we call bread and butter industrial. Industrial's not, we say it's the unsexy investment, and that's because it's just, you never drive by a bunch of warehouses and go, oh my gosh, that's amazing. They're just more functional real estate, but they're very, very popular. It is the darling in the United States real estate. They just did an analysis that I did in the masterclass with Scott, where actually the yields now are actually outpacing multifamily. So it continues to be the hottest place. So let's see what else I can do.
Well, again, in simple terms, what you're saying is that industrial is the best asset class within real estate at the moment to be focusing on.
Correct. So let me go through a few of my other slides here. Yeah, as you can see, it's just basic real estate, but it's located right in the heart of the South Bend area, Fort Wayne, Toledo, Chicago. It's got a really, grounded delivery area from Chicago to Toledo, Ohio, to Fort Wayne, Indiana. Good location for logistics. That's another element that we really like about it. We've got good comps on the project. We're buying it at half a replacement cost. We have supportive comps to that. We're buying it with good rents in place. And let me go back to my master slide for a second. So tell you more about the area. Rent growth is at 5.8, good for the area. Industrial was up to 8 to 32 in some areas, averaging the nation about 10. It's still 8, 9, 10. Still really strong. You're seeing flat rent growth in a lot of multifamily markets across the United States. So you got negative in a lot of office. So we've got a good growth area. Vacancy is 3.1 in this market. 3.1 is exceptionally low. It was like 15 to 18 historically in America in this sector. So we continue to have like logistics, good warehousing to drive the markets. Under construction, 0 square feet in this market. That's a good sign. There's a lot of overbuilding in certain areas, and a lot of those areas like Austin and Phoenix are going to be absorbed, but there's not a competitive set for a vulnerability to a bunch of new development. Even if there was, it's located really centrally, and another tenant would come in like that. But a $500 million company would have to go upside down for our lease tab exposure. Look at our name, marketing.com, better than Mossberg, about as big of a URL as you can get. So JL has done a good job on this and put that together. On the deal, it's a $5 million ticket. It's in a good economy. We're buying it under replacement cost. We have a great tenant in place. It's taken 6 months, grueling 6 months, because sometimes when you buy these things, this is the work that Scott does by finding us and we do for you. We have to find an opportunity where a company is selling their real estate. And if there's a bigger PE company buying it and then flipping the real estate to us as real estate investors, and the business gets capital to move on, and then the PE company gets to absorb them, it's a timing game. So what this really is, investing in industrial sale leasebacks is investing in structured financing. We take all the personal guarantees and the loans, and you don't take that risk. We put, $125,000 on the streets, due diligence, hundreds of hours to get to this moment. We're finally closing this. We plan on closing many, many more, in the next year because the timing is good. So on this deal, we decided to take a little bit of a hit. Like our debt is going to be between 6.9 and 7.35. We have like 4 banks competing. We've got debt right now, but we're still trying to enhance it if we want to. We're going to do either a 3 to 5 year term for the first time in our history on the 3-year term, because we're so confident in the history of America that there's going to be a reversal moment, but the loan would stay in place. It would just float at that point. But everything indicates that our loan is going to drop. And if we refinance at year 3, there would be a capital event, meaning we'd give some of your base capital back, and you would get, you would de-risk yourself, but still get yield on whatever capital you had left on there to the end of the process. So we do have the possibility for the first time of a refinance, which we'll talk about that in a second. Day 1, 8% pref. Second, we're going to start paying on this one early for money that comes in December. We're just going to start paying on it right away. We're going to close somewhere between the 1st and the 31st, but we have an agreement with Scott, so we're fine on timing. So for 5 years, 8%. The real yields on this with this kind of debt are like 5, 6, 7. So we have a little bit of a carried interest reserve because we're buying a cap rate when debt's a little higher. So we're going to take a little bit of the end of the deal, put it in the front, so we all have a good stable cash flow on a $500 million tenant, 8% pref monthly. And then at the time we sell the project at a capital event, we have an 80-20 between you and our investors, up to a 17% hurdle. And then we have a 50-50 over as kind of the success fee of our partnership and risk. We like to think we always aim, and we've been able to achieve like 20% returns. So what does that mean? 20% return means if you give me $100 in 5 years, I'm going to give you $100 on your $100, so you're going to get 200 back, right? So a good benchmark is aiming for 20. That's a good investment. That's a 2x multiple on your money. Now, most of the funds are delivering 6 and 16. As I said for Morgan Hauser, which they discussed, just keep moving is most important. Don't go just for great yields. Go for moderate yields too. Mix up your portfolio. But on this deal, we did offer a very attractive pref for this market over this debt rate. 8% pref monthly, day 1, and that'll be in there like clockwork. And we believe in the deal. We believe in the tenant. We believe in the market. A lot of positive elements to this deal. It's a cookie cutter. It's what we do. We've got a great need for the deal. We've got the use of capital is important to talk about. They're going to use the capital for the company that they're growing. And at that point, one more point. We have a couple extra acres for development. Now, why does this matter? This is kind of neat, guys. I'll show you this. And I'll have you, we'll go through the slides on the company real quick. But let me go to a map here. This is our portfolio, by the way, growing across the United States. You guys have invested in some of them, and thank you. A couple more coming. There's our team. Where's the picture of the site? Is it in this slide, Ryan? What's our slide? Has a picture of the actual physical. Yeah. There it is. So if you look here, they've got 1.93 acres for additional development. Now, why is that valuable to us? In the future, they may come and say, hey, we want to expand this company here. Hey, DWG and partners, Global Wealth, we want to give you a lease, and let's add 50,000 square feet. So if they come to us, they say 50,000 square feet, we go to the bank. We say, bank, we have a secured lease to expand here. Lend us 85% of the capital. Investors, let's bring in 15%. Let's get a 9 or a 10 cap deal in a 7 or 8 cap market. And let's build something quickly, and we get to expand the capital. So it gives us the opportunity to invest again into a $500 million company. It doesn't happen all the time. Another element is, besides the ability to develop this deal in the future, we have the ability just to sell it out in a portfolio. And this is a good size deal. So at $5 million, you're not only, with this credit, you could sell to a REIT or a mid-level fund, but this would be great for an American 1031. And those investments tend to be a good yield as well. So that would be my highline pitch before I pivot over. Scott, do you have any questions? Then I could bring in John and Ryan to talk a little bit about the financials.
Look, I think just a couple of things that you said, which are very important. So one of the things that we look for when we look for a partner, I always say the top 3 things we look for. So the first one is, does the partner have more than 10 years experience? In your case and in your team's case, is actually more than 20 years experience, specifically in this niche, in this industrial sale leaseback. So for me, that's tick 1. Tick 2 is, are you specialized? So are you trying to do 20 different things? Nope. You guys do sale leasebacks. You've done them over and over again in this process. And the third one is, are you prepared to put your own money into the deal? And as you said, you've already put, quite a bit of your own money in the deal, 6 months worth of work, and you're also investing in the deal and taking your own sureties in terms of, the bank risk, et cetera, et cetera. So I just wanted to point that out for everyone. The other thing that is important is when you do a deal, you want to make sure you're aligned, and it's quite a good way to segue into the financials now. You want to make sure you're aligned. And what you were effectively saying, Judd, is that investors are getting a preferred return of 8%, and then there's a hurdle of 17%. So what that is simply saying is that Judd and his team are saying, we'll make you money up to 17%, and we'll only start really making money after we've made you a return of 17%. And that's a fantastic alignment, because what they're basically saying is we're here to make you money first, and once we've made you money, we'll make money. But I mean, 17 is an aggressive hurdle, just to put it in perspective.
Yeah, it's strong right now, and John knows because they're doing it at his company as well. John subcontracts with us. We're honored to have him from $1 billion company, and we have a lot of seasoned guys behind me. Like I have that panel of consigliaries, John, some other company owners. We have our legal team, Doug and Kelly. They do about $4 billion of syndicated deals a year, so that puts us together for partner deals. Also, we have Robert Bianchi, he's an international tax specialist, as our controller. And then we have our environmental team, it's been best across the nation. So, we really make sure that every time I sign on the guarantees, I've signed on about $35 million on this first $50 million tranche. So, that we make sure that we are making secure investments. It's personal. So these rates are a little bit higher than we should be paying in this market, but we're in momentum and growth and partnership, looking for the long haul.
Yeah.
With that being said, thank you guys. Let me jump back over to tenant overview, and then I will have who would like to start, Ryan? Or Ryan, why don't you start with the highlight on the tenant, and John can talk a little bit about the financials.
Sure. Yeah, I'm going to talk loud. I'm actually going to bleed over to Judd's microphone, so I'm going to talk loud. Can you guys hear me okay?
Yes.
Scott?
Yeah.
Great. Yeah, so it's it's essential to understand the underlying businesses on all triple net leases, but specifically industrial sale leaseback and the industrial sale leaseback space. In this deal, the structure can seem a little confusing at first because there's a lot of different entity names tossed around with marketing.com, Mossberg, DWG, etc. So I'll kind of break down how that looks to make it a little more clear for everybody. So you really have the tenant side and the sponsor side. The sponsor side is us, the landlord or sponsor. You'll hear both of those names kind of tossed around, they're synonymous. And on the tenant side, I'll kind of go from the top down. So on the tenant side on this deal, you have JL Equities, which is a Florida-based holding company ran by Ron Salou, and all of the tenant side companies basically flow up into this gentleman. Ron is he's a 20-year veteran in investment banking, worked at Morgan Stanley in New York, Milano Park. I think he's done like 20 billion in mergers and acquisitions in his life cycle. So very experienced gentleman, and really found that this sector of marketing, he found a way to purchase these companies using sale-leaseback proceeds and cash injections from his owners in order to basically fund these acquisitions, consolidate backends, and he's been successfully done so, as you can see here with JL doing about 500 million in revenue a year. Our tenant here is marketing.com. Marketing.com is a subsidiary of JL, which is a main entity of the holding company JL. Marketing.com itself does about $220 million in revenue a year. Marketing.com will be our tenant. They are purchasing the current tenant, Mossberg. This will be a simultaneous close. So at closing, Marketing.com will buy the business of Mossberg and sell leaseback the property, the real estate, to DWG Capital Partners. So that's kind of a flow of how all this works, and some of the entities together.
Oh.
The main draw here, why is JL/Marketing.com wanting to acquire Mossberg? Mossberg has about $4 million of labeling equipment, and one of Marketing.com's largest clients is HelloFresh, the $8 billion public company in America. And this is going to be about $6 to $8 million in revenue. HelloFresh is asking Marketing.com to continue their labeling and to expand on their labeling. So this will be acquiring Mossberg enables Marketing.com to have the ability to complete HelloFresh's labeling side, which is going to be a pretty big increase in revenue and to grow that client relationship. Naturally, they'll also utilize Mossberg's, current clientele as well.
Guys, thanks a lot. So I will say that is interesting. We're about $50,000 into walking through just the complexities of an accounting level. The banks, because this is a high growth company, it's interesting. I don't know if the investors want to hear every detail, but I think it's important. It'd be easier to do somebody smaller and more seasoned. Like this is a really rapidly going company. So we had to bring in our top minds and guns and hours and hours and hours every bank to show them the entire PE structure, because banks are being more watchful right now. So as you can see, the bigger they are, the more complicated they are. So we're bringing, that high level institutional quality deal to a small investment. So with that being said, I'll kick it over to John and just see, John, if you have any additional comments, and thanks for coming, buddy. I know you're slammed right now at the end of the year.
Yeah, no problem. Thanks, Chad. Yeah, no, I think Brian covered a lot of it. And Judd, you also just added some color as well. I think the only other thing I'd mention is, the thesis around acquiring these printing and more paper-based companies that Iran Salou is executing on is these companies, they're viewed as kind of the cigarette butts of the industry. They're looked at as kind of a dying breed, but there's still, if you go anywhere these days, there's still print media that's necessary for everything from, especially where Mossberg focuses, which is on pharmaceutical packaging, and other foldable and kind of glue packaged media that needs to be produced for packaging purposes across a multitude of industries. So when we were speaking with Iran, it's really most customers are very sticky to those specific producers of these materials that they've been working with for a long time. It's expensive to switch from one printing company to another, and also time intensive for the types of products that are being produced. So as long as they're getting the items that they need, it's more accretive for somebody like Iran to go out and buy an existing company, get their equipment, which was already, he could buy a company with its equipment for cheaper than going out and buying brand new equipment as well. And so his play right now is to go out and aggregate a lot of these companies that are still cash flowing well, but it's easier to go out and acquire a customer base that way than going out and organically trying to secure new customers as well. So as Ryan touched on, this relationship with HelloFresh, they're able to utilize a lot of the things that are in place at Mossberg to grow that relationship across other brands that they already have in-house. So it's really a synergistic acquisition for them. Mossberg alone has already been doing 18 million in revenue just out of this one facility historically. And so we view this as kind of a roll-up play for them to be able to go in, cut some of the fat in there, and introduce it into their already kind of well-oiled machine that they have under the marketing.com and then greater JAL umbrella. And so that's kind of the highlight of it. And I guess the last thing is, all of these smaller companies that they're going out and buying, like the Mossbergs and other kind of print shops, is that they can buy these at very attractive prices, 1 to 2 times EBITDA versus most other companies out there that are in a more sexy industry are trading at 6 to 10 times EBITDA. So they're going out and acquiring these things, and day one they're cash flow positive, and after 2 to 3 years they've already gotten back all of their investment capital, and continuing to kind of run that flywheel. So we like the industry, we like the players that are involved here. And we think that their experience in doing investments like this creates a very good opportunity for us as landlords to continue to collect rent and then grow with them as they go forward and buy more companies with real estate attached for future sale leaseback opportunities.
Thank you.
Listen, Judd, can we go to the financial page? Let me just see what slide it is. So all this there, that's what I'm talking about. So all the one there, yeah, that's the right one. So all the
waterfall or pro forma.
I think the waterfall's the better. Is that not the one like where you just got an average of 100?
Yeah, I would just say, I mean, just to simplify it for your investors, right? Like the waterfall on this, the pro forma on this is strong because we have a little bit of carried interest to make sure we're delivering the 8% regardless. And then on top of that, our yields are high enough for us to have partners, right? And then here's the slightly diluted partnership when you come into partner 80-20 with any company, right? And there they are in front of you, as you can see there. So do you want me to walk through them quickly or?
No, well, yeah, look, I mean, if you just to give people, not so much the waterfall, let's go back to the one before that. I just wanted to kind of, so there's two things I wanted to show people. So firstly, everything that they're showing you in this, all the slideshow is actually all available. It's on our platform. I'm going to show you where it is available. So you don't have to worry. I mean, it's how many slides is it exactly? 20 something slides, 22 slides to be exact. And you can actually go and look at all this detail. But what I'd appreciate is this one specifically, if you could just kind of give a quick overview of how this works, so that the average investor sitting here and can make sense of it.
Yeah, you bet. So I'm even going to point out, like, the reason we're not charging OPEX the 2 years is because that's when our first years of this loan. So we're actually going to take our asset management fee and pay all the OPEX as well. So we're kind of, just to point that out, like, rates are so high, yields are so low for us as your partners. We generate the deals, and then we're going to benefit on the back end, but we're really making sure we give you guys the yield in this time until rates fall again. So so you can see here our overall price is $5,032,000. Our equity is 1,829. Our debt right now is 3,202,500. Our rate's 735. I just want to point out, like, a couple of years ago, man, 2 years ago, it was 319. So this is structured finance. This is what we're talking about. The Fed has raised over 400 basis points, but sophisticated people keep moving. So we have enough debt coverage ratio. So you see that 1.3? That 1.3 means that the rent is 133% higher than the debt service. And that's how we make cash flow. That's what debt coverage ratio is. How much higher is your rent than your debt? And then that's our cash flow. So you can see you want to have a margin on that debt coverage of at least 1.2 to be stable. We have a nice chunky coverage of 1.33. So we have a good lendable project. That's a key element. You can see here on our carried interest reserves, I'll make this point. So we're actually taking 109 so that we can all make cash flow the first 5 years until the refinance here. We're actually taking a little bit of that cash, the end profits, about $100,000. We're putting it into the deal and we're paying an 8 cap together. So us as a collective, or why interest rates are high and cap rates are high. For the short term, we're using a little bit of reserves to make sure we as a collective company all make a solid 8. And so what are you doing with that, Scott? You're taking a little bit of the end profits, moving them up so everybody has a vehicle they can feel good about. And why do you need a vehicle you feel good about? Because some banks are paying 5% now, right? I mean, that's flat money. Of course, real estate, you have appreciation, depreciation, interest write-off, loan pay down. So an 8 yield might really be a 13 yield in real estate. That's how the rich get richer. That's a different class. But we've got good fundamentals on this project. We're using a little bit of interest reserves while rates are high. Our exit cap rate, we're buying it at 8.25 to an 8.5. First year, we're just putting a 7.5 on there. But according to where John used to be at Store Capital, Chris Volk used to say you buy an 8 to sell something about a 6.7. There's about 130 basis points just by creating a bond with a new lease. That lease is it's a cash bond, over time. So as you can see, in year 2, we have a $500 million tenant on our rent. So we've compressed the rate. We're buying it at 8.25. We compressed it to a 7.25. Even though this is Indiana, this is really attractive, large place. It's a little lower where the market is right now, but we're very confident in where we're headed and where we're going. So, we have an attractive exit cap rate. And below that, you can see where our yields flow down. And the potential for outcomes pretty good. Now we have a pay down of 321 on the closing cost line. And you can see about the fourth year, it's a great moment for us to either refinance, as we have a little peak period there at 18.96, or to give back some of the capital. And you can see this, if you see here, this is an important distinction because you're not going to see this in a lot of our deals. Boy, I am not good on this on this spreadsheet. I keep screwing up with something there. Okay, if you see this 852, if we refinance this 735 at, let's say, 6%, we might be calling Scott and go, hey, Scott, we're going to, of the 1.8 in our bank of our investors, we're going to send back about 34%. And you'll be like, okay, well, I'm going to keep my money at 8%. I'm going to keep my yield on that money in, but I'm going to de-risk, and we might deliver some cash back to the investors early, or we might just exit. So, that's how our deals work on a 3 to 5 year window. It's like during that, my job as your captain here with your trust is to say, at what point do the markets say we should exit or hold? Anything we buy that if we end up being in a holding cycle, that, it's good American real estate, we'll all really prosper. But the standard, numbers are like 3 to 5, 3 to 7 years. So our job for you is to get the highest peak in the investment cycle, but also not jump out of something that's just a good deal because it's a nice fit for your portfolio.
Judd, there's one extra slide. If you just go one more slide on, it's the investment profit waterfall. It's actually the one I was trying to look for. Yeah. Yep. So that one there, and it's just showing someone if they invest $100,000. Your one's a little bit different from mine. Anyway, it just the brochure we've got. If you don't mind, I'm going to steal the screen here quickly. Let me show, because this will be the. Oh, there you got it. There you had it. Oh, well.
Are you looking for the?
This is the one I'm looking for. I'm stealing it back from you. But yeah, it's just this one. I always like this because from an investor perspective, it's fairly simple maths. Then they can say, right, I put in $100,000. There's my initial investment there of $100,000. What does it mean to me in terms of my cash flow? In terms of, so there's my sort of my annual cash on cash. Then what does that mean in terms of the capital growth? And you can basically see the total cost here. Sorry, you can see the cash on cash, you can see the total return in IRR, and then you can sort of see the income multiple. So the reason I like this is because this literally shows people, on $100,000. So whether you're investing $10,000 or $1 million, at the end of the day, I like it just because it keeps it to a fairly simple multiple.
Yes, absolutely. And as you can see, that's some of the American benefits on our current tax laws below that. Internationally, I know that doesn't apply. For national people, it does apply. There are some tax benefits. They're tailing off, but there's a political year ahead, so I think they may be restructured and come back even better. We'll see. But yeah, absolutely, Scott. I mean, keep your investing simple. If you look at a table, and all of us look back to if I'd saved $50 a week when I was 18, right? Everybody would be a millionaire. Nobody does it. $100 a week, you can retire. If you're young in here, just put that money away every week. Is the return of it is amazing. But you'll see here in our structure is the bottom line. Are you close to, the stock market's return like 14 to 15, very volatile, but that's without taxes. That's without all the benefits of real estate. So real estate yields at a 20 can be significantly higher. So you can get pretty wealthy just trying to continue to look for 2x multiple deals as your theory in good real estate over time. So we aim for that. As we said, it's going to be a little tighter during the cycle, but with a refinance theory, we're in a good position. And I think the yields out are day one. Like the 8 yield is, a lot of companies aren't offering 8 anymore. Where we're at growing, we're going to go from 50 million to 150 million, hopefully in the next year. Because we think this is a prime time to do so. We're offering a higher pref when a lot of companies are having to cut back.
Yeah. And I think just to show you just a couple of things that are important, you can, if you're going through their brochure, and I'm now just giving you the zoom out, you can see the different deals. I know that Judd has already been through the team, but if you want to go and read who Judd is, who Ryan is, in terms of there's John in terms of the whole breakdown. So you can literally go through, you can see the whole team. And then what I love about your brochure also, it makes it like, why us, the company? So why invest with DWG? What are the targets, the mid-market, etc. So again, I'm not going to ask you to go into all this detail, Judd, but I just wanted to kind of show people it's here, should people want it. What is leaseback? What is a mid-market? How does it actually work? So it's basically all here in this brochure. I'll stop sharing now, which again is on the platform. But I basically wanted to kind of give people the idea tonight or today, whatever time zone people in, is to kind of get the high level from you guys, but the substance is there if people want it.
Absolutely. I see you have a few questions. Is there anything else that you'd like us to address, Scott?
Yeah, so two things basically. One was Alex, you found something that you wanted to share, which I thought was quite relevant, basically around the partner.
Yeah, let me just grab my screen here. I think this speaks to the guarantor that John and Ryan spoke to. It was just quite interesting while you guys are talking. I was just jumping on online and just going through the different, the different partners, and it was quite interesting to see like how diversified JLA is actually in the States, and actually understanding what their business model is and actually how big they are. Because obviously that is ultimately one of the core risks that we have to look at, and it was quite interesting. HelloFresh, I actually didn't know what it was, and when I actually went into it, it was actually quite fascinating to understand. It's a massive growing demand as well, because e-commerce it's coming. It's not dying. It's that whole industrial revolution. We're not going after the wagons. We're going after the cars. Industrial vehicles. So yeah, I just wanted to share that, and I've already shared it with a couple of investors online. So I've just shared those links, and I'll make sure that in the follow-up email, I'll just add it, because I do think it's quite interesting to understand, who, when we speak about the tenant, who is it actually?
Agreed. And that's what's neat about this deal. That's why we fought for it. To be honest, we started in June, guys. I almost cut this loose, and I went in during the Fed rate changes, and I tried to get them to give up 75 basis points in price, and they battled me because they're big, because it's a good tenant. So we decided to move forward anyway. There's a saying my dad used to say is no ask, no get. So my job is to try to get the best price. So I don't want to have a reputation of retrading my obligations, but we had a good narrative under the Fed decompression to ask for that. But the tenant is big enough. We want them on our portfolio. That's correct.
Just a quick one. Yeah, there's a question from Diana, who's one of our mastermind members, and she said, "Is there a high hyperinflation? How will it affect the income?" So in simple terms, I think she's saying if there's hyperinflation, how will it affect the income?
I'll throw that to John. I could give you my answer, but John, you want to discuss hyperinflation as it relates to income and escalations? I think it's kind of a separate conversation, but perhaps you could frame it.
Yeah, I think if framing it in the context of JAL and the operating company itself, I think as we've seen over the last 2 to 3 years here in the US, inflation's been higher, and so there was about a 12-month period where net income went down because they weren't able to pass through costs to their customers efficiently. But now that we've passed that 12-month period, those costs are starting to flow through to their end customers. And the thing about inflation is that everybody's cost structure rises. It's not just one player in the space, and so it's from my perspective, how the last few years have shaken out. Revenue will obviously increase, costs will increase, but the overall, I guess, relationship that JAL has with their customers is that they embed a margin that they in all of their contracts, and those margins have usually a 12-month reset period. So it's if there is a hyperinflation, you can expect revenues to go up, costs to go up, but that net income to remain fairly stable, because they won't really have anywhere else to go either. These products that they need, whether it's pharmaceutical packaging or HelloFresh and their mail order meal kits, those different items are going to continue to be to need packaging, which as I stated before too, there's high switchover costs to go to a new a new vendor for these items. So there's multiple layers of stickiness. They'll hit a bump in the road, but I don't see it being something that would take them down by any means.
Just threw that up there too, John. I think that's complimentary. Is like we are watching inflation as it relates to debt. I'm a capital markets. I started Newmark Capital Market. Newmark's one of the top 3 companies in the nation. I started the LA office. That's kind of my institutional background, and so done billions of dollars of deals and a lot of debt. We're doing a lot of debt now. I still have a brokerage firm, so we have to stay on top of this. So, what was the hyperinflation that you've seen in the United States? The highest you saw was in 1980, completely different capital markets structure. The utility of how we move capital around is much, much more efficient, and our internationalization is much more efficient. And you can see here's the rates that the variations that went up here, up and down, 3 to 4 rates that were contained. And we've got a pretty effective system of containing inflation in the United States of America. So I just think we are watching inflation as it relates to those rates. So I think it's a limited, as John said, it's a limited exposure, but if it does occur, you've got a tenant that let's say the worst thing happens. Let's say this tenant has issues, John, right? This size of company is bundled, resold, and the lease becomes renegotiated. We hold the real estate, we cover the variation. We bought it properly. I mean, it's such an extremely long shot, but companies like this don't go away. They're just restructuring.
Yeah. Just one thing, Judd, I did ask Ryan, someone asked me, that first presentation, the one you just showed now, I'd be great if we could add that, because I'll add it to the platform for people if they are looking. So just to show everyone. So basically, in simple terms, if you go to the platform, the deal is sitting under review. We're literally just waiting for Lemonway to open it up for everyone. You can go and read all about it. You can see all the pictures. The recording of the webinar will be up here. You can go and put stuff into the calculator. You can download the documentation. So everything that we've been showing you today is literally sitting here, and you can go and see everything in terms of all the different everything. So it's all available. You can literally go and read all about who the partners are and everything about them, and the investment summary and DWG and everything else. So it's all there. But I just wanted to summarize it quickly for everyone in terms of what I like to do. Oh, why is this? What I always like to do.
I'd like to invest in that, Scott. Call me later.
So what I always like to do is just sort of summarize it. So just for people to understand easily how it works. Well, you've all got your money sitting in your investor wallets. It goes on the platform, the Wealth Migrate platform. Ultimately, you've got an investment opportunity. So we've got this particular deal that the DWG has taken us through. We aggregate all our investors together. We invest through a tax efficient structure, and we basically have deal ownership. They pay us monthly. When the money comes in, it goes back into a deal wallet, and it goes back into your wallet. So I know people always visually just want to see how it works, once they're an investor. And then just in terms of the investment summary, and I even updated this a little bit just while you were talking, Judd. And I'm sorry, I'm a bit of a nerd when it comes to cheat sheets. But for me, you got a prime location. And if I understood you correct, it's one of the top residential markets in America at the moment in terms of growing and specifically with regards to logistics. The second, is that correct? Did I get that right in terms of what you said?
Yeah, the residential market is secondarily grown because logistics has gotten so strong in the area that the market has boomed. That's post-pandemic pressure on a lot of sleepier Midwest markets.
Yep, perfect. You've got a Class C industrial building. You've got the size in terms of opportunity. You've got the purchase price with a 50% replacement cost. That's always very important. If a brick costs $1 and you're buying it for 50 cents, you've immediately locked in value before you get started. You've got a cap rate of 8.25%. You've got a cash on cash of 8% plus. That's per annum, but it's paid quarterly. You've got an IRR of 17% plus. You've got the tenant of marketing.com. And in terms of the large size of JAL and a total revenue of over $500 million. You've got a lease term of 20 years, triple net lease, and with 3% escalations. And then the guarantor, you got a corporately guaranteed by JAL. So you're not even dealing at one level, you're dealing with the holdco basically. And then you're dealing with marketing.com, a technology-centered marketing platform with recent revenue exceeding $220 million. So for me, that's sort of thanks to some work Alex did, but that really put together a summary for people. There, I will share this PowerPoint with people, but you've got a market analysis, so it takes into account the location advantage, the market demand, and the rent growth. You've then got the financials and the financing. So again, just to make it easy for people around the loan to value and the projected returns. And then finally, some of the investment advantages in terms of what you're looking at between a high cap rate, excellent financing, and above market returns. And then finally, to DWG themselves, what is their experience in terms of their expertise, repeat opportunities, and this mid-market focus. Risk mitigation, you're dealing with an experienced team, you've got a secure lease, and you're dealing with the market trends going in the right direction. And then lastly, every single deal that we do, we always look at the risks and the opportunities. Each one of them is put down on the platform, but the three that I thought, which I just highlighted, there's economic sensitivity. So as Judd has already spoken about in the capital markets, so you've got to have partners on the ground that know what they're doing, which we do in DWG. Tenant specific challenges. So again, they said they've spent 6 months doing the due diligence and trying to capture this deal and spend $125,000 going through that process. So again, with the right partners on the ground, that's how you manage that. And then interest rate and financing risk, and I think Judd's spoken to that quite a lot. So those are the three major ones from a deal risk perspective. From an opportunity perspective, I think you've got very attractive returns at the moment with a 3 to 5 year hold. You've got a diversified revenue stream. You've got a strategic location. You've got strategic advantage. You've got financial prudence. You've got an experienced team. You've got market alignment. You've got future potential. And those are the 8 primary sort of opportunities in terms of where we see this, including that replacement cost at 50%. And so if there's any questions, I'm going to stop sharing now. If anyone's got any questions, my suggestion is to ask now. Otherwise, I'll wrap it up. I can see we're getting on the hour and I don't want it to be too long for people that are watching the recording as well. So let me just see here. So Peter, are there any deals that are coming for $100 or we will be letting you know, Peter, in terms of we've got some exciting ideas coming up to let some of the smaller investors be able to participate. I got one last question for either of you, actually, any one of the three of you, in terms of the process. So my question is, it's a funny time of the year. We're sitting, about to go into the festive season. Many investors are kind of what I'm going to refer to as armchair investors, and they now sort of say to themselves, "Well, tell you what, it's nearly December. I'll look at this in January." And my question to almost all three of you would be, why should someone really pay attention now, do a little bit of work this side of Christmas so that they ultimately can take advantage of this versus just, I'm busy, I've been a long year and I'll get to it next year?
That's for me?
Yeah.
Okay. Because capitalism is awesome. No safety net, no ceiling. Free market capitalism rocks. That's my opinion. I mean, I think that way, right? Like we both have super free societies. And those of us that hustle capture opportunity, and then it's time to rest. So, I'm going to Europe. We'll probably close. I'm going to go surfing in Tofino at the end of the year, and I'm going to rest and I'm going to shut down. But right now, it's time to harvest. And next year, we're already seeing compressing interest rates. I've got so much pressure. I've got like 7 other deals that people want to buy. We'll talk to you about later. We're going to get significantly bigger pretty quickly. And this is a great time, and all the hard work is done. Ryan is sleepless. Look at him. He's and it's literally taken a yeoman's event for you guys to be part of this. This is a good bond. It's a good real estate. It's a simple decision. Click the mouse from your office in your house with Scott. Get it done simply. And come on, be our partner institutionally. All the benefits of our institutional experience of everybody in the room is yours by clicking and funding, and we'll take care of it. And it's simple at this point. So everything that's hard to be done is done. The third parties were done. The deal was secured. The financing is secured. The timing is good. It's a good deal. So I think that's why you hustle a little bit for the holiday.
Yeah. No, and I think just to summarize as well from our side, it won't be here in the new year. So, the point is, as a deal goes, this is a unique deal. Ryan has, I think Brian's probably blocked me on his phone because I've been hassling him for, every month, like, hey, when's that deal coming? It looked really good. So we're really excited that it's here. And I sort of say to investors, you know, you can't time the timing of when good deals come along. They come along, and rather go into the festive season with the peace of mind knowing that you've deployed your capital, you're diversified. And I think the thing I like most about DWG is they pay us every month. It's actually quite irritating for us from an admin perspective, but it's a bloody nice problem for the investors to have in terms of, you know, getting paid every month. And so when we talk about passive income, I think it's probably the best way to end off. I haven't dealt with a team internationally around the world that pays monthly, pays on time, and that's all investors are looking for. And I deeply appreciate everything you guys do at DWG. And thank you for this investment opportunity, and thank you for allowing me and the investors to participate.
And I just want to say one last thing. Scott, you've been very successful with us repeatedly, so you have a great reputation with us. And we're overfunded, and we have benchmarked money for Scott and Alex and your partners that will forward if the closing happens before you come in from our own reserves. So you're a great partner, and we're willing to let you close a little bit below our American and other area counterparts, because you're a great team. So thanks for coming along, and it's an honor and pleasure, sir.
Awesome. Thanks, everyone. Look forward to being involved in the deal. Cheers, man.
Thank you.